Good morning. I'm reporting from Dallas, where the Texas real estate market continues to absorb shifting monetary conditions with measured resilience. The Lone Star State's commercial corridors are navigating a complex landscape, mortgage rates holding firm, employment steady, and housing supply arriving at a deliberate pace. Today, we break down what these dynamics mean for your portfolio. This is RipplEffekt's Dallas Market Brief. The Dallas metropolitan area is operating within a distinct macroeconomic environment. The 30-year mortgage rate stands at 6.55%, a level that continues to shape both acquisition strategies and refinancing timelines across the region. That rate exists within the broader context of a federal funds rate at 5.33%, reflecting the Federal Reserve's measured approach to monetary policy. What we're seeing here is not volatility, but rather a period of stabilization. Lenders have adjusted their posture. Developers are pricing accordingly. And institutional capital is methodically evaluating opportunities on a case-by-case basis. Let's isolate the key metrics that matter most for your decision-making. First, the mortgage rate environment. At 6.55% for a 30-year term, we're in a range where institutional financing remains accessible but pricing discipline is absolute. There is no margin for error in underwriting. Every basis point of operational upside becomes material to returns. Second, the Fed's posture. A federal funds rate of 5.33% suggests that policy remains restrictive relative to historical averages, but the trajectory is what investors should monitor. Rate cuts, if they materialize, could unlock capital currently sitting on the sidelines. Third, employment. The 3. What's the underlying trend here? Dallas is in a transition period. The market is no longer in growth mode, it's in maturation mode. That's not a negative. It's a recalibration. For the past several years, Dallas benefited from massive population inflows, cost arbitrage relative to coastal markets, and corporate relocation momentum. Those tailwinds haven't reversed, but they have moderated. What we're seeing now is a market where real fundamentals matter more than narrative. Tenants are more selective about location. Landlords are more disciplined about rent expectations. Lenders are more rigorous about debt structures. This environment actually benefits sophisticated, patient capital. The Dallas market is moving at deliberate pace. For institutional investors, corporate occupiers, and portfolio managers, this moment requires nuance and precision. RipplEffekt provides detailed asset-level analysis, market-specific trend intelligence, and deal-by-deal risk assessment across North Texas. Our research team tracks every significant transaction, tenant movement, and development project. We model financing scenarios under multiple rate environments. We quantify location premium and obsolescence risk. This is intelligence that moves markets. Visit us at RipplEffekt.com for the full intelligence brief.